Look, don't get me wrong. I'm happy the stock and bond markets have been going up over the last month, but I'm still not comfortable with the way they're going up. So how's it looking going into next week? So the entire question of this video is, do we have healthy stock and bond markets? Well, let's take a look at what we're seeing. If we take a look at the price of the S&P 500 versus 20-year treasury bonds over the last 3 months, you can see they started out initially both falling. The S&P 500 had a double bottom here and has been rallying higher. And 20-year treasuries had a bottom back here a little bit later than the S&P 500, and they have been rallying. So that all looks good, right? In terms of equities, what are we seeing? We had a second bottom forming indicator here. Off the chart to the left, there was an initial bottom forming indication, a very strong one, which is good. And then we had a bottom confirmation back here at the end of October. This looks good too. Now we have what appears to be a second bottom confirmation forming, although we're not quite there yet. The confidence level still isn't quite high enough to get us there. We'll have to see where this goes next week. In terms of equity versus safety rankings, you can see back on August 17th, we had a very healthy stock market, but an unhealthy treasury market because long-term treasuries were ranked dead last. By September 30th, we had an unhealthy stock market and an unhealthy treasury market. By November 4th, things were looking a little better. And now, this past Friday, we have a very healthy looking treasury market with longer-term treasuries ranked 1 and 2, and then a fairly healthy looking equity market with the NASDAQ ranked number 4, but it's ahead of the Dow, SPY, and IWM. So this is starting to look like a very healthy stock and bond market. Looks great, right? Let's take a look at buying and selling pressure because that tells another piece of the story. If we look at the Dow Jones Industrial Average buying and selling pressure, you can see over the past 2 months and the past 1 month that the buying pressure has been steadily increasing and is currently above the selling pressure. Selling pressure is this orange line. Buying pressure is this gray line. For the S&P 500, same story. The buying pressure has been increasing over the last couple of months and over the last month, and you can see that it's well above the selling pressure currently, even though the price has been moderating a little bit here. NASDAQ 100, same story. Buying pressure increasing and currently above the selling pressure. Russell 2000 small caps, very similar story. Buying pressure increasing over the last couple of months, although it has been waning lately. Now, Ark Innovation is sort of at the other end of risk exposure. Because these are innovative companies, there's a lot of risk here. But even with these, you can see the buying pressure has been steadily but slowly increasing over the last couple of months. Now, this doesn't look as strong as the Dow, the NASDAQ, the S&P 500, or small caps, but it is improving slowly. Let's take a look next at sector rankings. We're currently seeing energy ranked number 1. This has been there for a long time. Now you'll see these don't go 1, 2, 3, 4. That's because there's 3 parts of each one of these in the model, and we discount them by 1 or 2 standard deviations. So they're not going to go 1, 2, 3, 4, but energy is ranked number 1, aerospace defense number 2. No surprise there with what's going on in the world. Financials ranked number 3 in third place. Why? Because interest rates have been going up, and financials benefit from that really, really well. General industrials ranked number 4, and then the Dow, which has been outperforming the other indices, ranked number 5. What bothers me is the cash is still up here in this best sector rankings. I'd like to see this off of this table. And we all know gold has been doing well lately. And why has gold been doing well lately? Well, because the dollar's been falling. And why has the dollar been falling? Because the markets feel that the Fed is at the end of its tightening cycle. What are the worst ranked sectors here? Well, Bitcoin right at the bottom, innovation, Ark near the bottom, 20-year treasury still near the bottom. Now you'll say, well, but wait a minute. You showed us that 20-year treasuries, longer treasuries, were ranked number 1 and 2 in equity versus safety. That time frame is a shorter time frame. This looks over a longer time frame. So it's going to take longer for these bottom ranked ones to move up the ranks here. And speaking of treasuries, how do they look? Well, we had a huge spike in buying pressure here in the 3 to 7 year intermediate treasury space, but you can see that has really fallen off recently. So we'll have to see how this plays out going forward. Go out a little bit longer, 7 to 10 year intermediate to long treasuries. And again, we had a big spike in buying pressure, which has fallen off. 20-year long treasury bonds, again, fairly big move up in buying pressure, which has again fallen off. What about gold? Gold, as you can see, has been moving up recently, and I described why. And again, the buying pressure has been moving higher. Now, what about Bitcoin? Bitcoin has really taken it on the chin here. And why is that? Well, there's a lot of risk in the general blockchain market. If you follow crypto and Bitcoin at all, you saw all the news about FTX and the trouble they're having. Until there are clear rules and clear boundaries about how blockchain gets managed, there are going to be instances and bad actors like this where things are not handled properly and it poses risk to the crypto markets. Do I think cryptos are going to die? No. They're clearly the technology of the future in so many ways. But until these risks get sorted out and eliminated, there's going to be risk here going forward. I'm still trying to find some inspiring words here, but the unfortunate truth is that the stock market and the bond markets are all moving up in a very listless, tentative way. The big improvement here is that they've both been moving higher. The end result is you need to be in the markets to take advantage of any potential upside, but you also need a healthy portion of your portfolio to be in safe haven assets to protect against any potential downside. I'm Calvin Rose, and thank you for watching Invest Smarter today. If you like this video, please hit the like, subscribe, and notification bell so you won't miss an upcoming episode of Invest Smarter. That's all for now.